independent investment professionals. That's their family office to look after all six banks. So naturally, they want these family offices to go into be able to set up in a place where there's no tax on investment income. Hong Kong and Singapore, that's in tax on capital gains, and there's no tax on investment either if you qualify the family office regime. That's why in the past 3 years, you hear a lot about Singapore and Hong Kong attracting family offices globally to these two places because of the low or no tax regime. Talk to me if you have further questions. You guys are really young, but if we met 30 years ago, we would say the trend at that time is bank with Switzerland because Switzerland has banking secrecy. When you put money in the bank in Switzerland, if the banker disclose your information to anyone, including wife or husband, you go to prison. Actually, Singapore later have that rule too. Many people abused it. You know the security cap? This is actually money they earn in your home country and taxes were not paid. Meaning that you are actually helping local people to evade tax in the home country. So the banking secrecy was totally abused. So in the past 15 years, there's been a lot of rules that go against confidentiality and privacy. Because those practices pre-exist probably 100 years, so it takes a lot of time to unwind. A lot of those have been sorted out, but more efforts to be made. So I think if you're reading financial journals, you see a lot of news about getting rid of transparency. To share with you one recent trend is, in the past, it's very common for clients to set up, like business entrepreneurs to set up a company that has no staff. We call it paper company. The company address actually the address of a lawyer, accountant, but it keep collecting revenue from customers and pay no tax. Those days are now gone. These companies now require to have proper registration, business registration, proper staff, we call that economic substance, and pay tax. So that's something new in the past, I think of 2 years. Likewise, because we have a lot of brilliant lawyers, they will study all these laws and try to find loopholes, and to create really complicated structure to make sure that whatever tax or reporting is to be done because of these loopholes, no tax need to be paid. Those days are gone too. Many countries, including the US, China, many European countries, have something called general anti-avoidance rules, meaning that if the structure itself is so complicated, remember the structure I showed you? Those are called simple. Complicated ones are 4 times longer. Then the tax authorities will say, actually, I don't see why you have to do this except to avoid tax. I simply ignore the structure. Scary, right? But now the tax authorities have the power to do so. Last but not least, there's a recent trust case I'd like to share with you. For those of you who've been eaten in a famous Chinese restaurant in China called Southern Beauty, the big boss, Miss Dang, recently sold this business to a private equity firm. After she sold the business, she collected money and quickly put the money into a trust. Very soon, the private equity firm realized, hey, wait a minute, Ms. John, the financial numbers you presented us seems wrong. Actually, it was fraud, meaning the numbers were overstated. So they pay a lot more for the company than they should. So the private equity firm sued Ms. John. But Ms. John said, okay, sue me. I have no money because she put the money into the trust the next day. Okay, so the PE firm did not give up. They followed her and found out that she'd been investing in New York. I think New York in the States, representing some company. And was later discovered this company. Remember, under trust. There's a company. There was a company under trust. So the trust was set up in Singapore. So the PE firm sued Miss Zhang and the trust in Singapore, requesting the court to freeze all the money sitting in the trust account, waiting to find out what's going on. Singapore court freeze everything, request all the banks to provide the relevant emails, and found out something interesting. Found out that Ms. Zhang was banking with Bank A, but the trust have account with Bank B and Bank C. So after she sold the business and collect the money, put it in Bank A, and asked Bank A to bring money to Bank B and C, because those are the trust accounts. Bank A, of course, are very sad because there's lots of money, begging her not to leave. And she said, you must review the money right away, because I'm a bit worried the private equity firm will sue me. And the Bank A banker put that in an email to her boss, saying that, sorry, I cannot keep her with our bank. Now, why do I need to explain this to you in details? Because in the trust world, you cannot use trust for wrongdoings. What's wrongdoing? For example, I cannot say, hey, I'd like to sell the trust for my children, but to get money, my children has to kill someone. You kill one person, I'll give you $1 million. No, that's illegal. The trust cannot encourage illegal activities or immoral. Similarly, if there's a credit claims against the settlor cannot use the trust to defraud the creditor. So originally, no one knows what's going on Ms. Zhang's mind when she set up a trust. For those of you who know who she is, her son recently went through a divorce with a famous actress in Taiwan. So she could easily say, oh, I'm using the trust to protect my son, because he keeps seeing bad women. She can say that, right? But this email confirms that she knew something wrong with the deal. Because without this email, I think if I were her, I could argue, oh really? My numbers were all right? I'm really bad with numbers. I don't know how to cook. Must be the accountant who cooked the numbers, who cooked the books. Let's sue him or her, right? But this email confirms she knows everything. So that's why this court case is very interesting, to warn everyone when you do trust planning, you have to be careful not to abuse the benefit of trust. It's like buying medical insurance. If you're healthy, you buy, you're sick, you can claim. But you're already quite ill. You cannot pretend that you are healthy and try to get the insurance company to pay for your medical bills because you are not insurable. The concept is a bit like this. So I think this is the last sharing I have in this slide. I think that's pretty much it. So thank you everyone. I hope you are halfly awake. And I hope you have share some insights. If you have some other things like discuss, I can hang around a bit. Or maybe this is a break, right? Okay.
So if you have anything you would like to ask Mr. Aoyang, and then just feel free, and then we'll be around during the break for around 10 minutes. So yeah, just I think that for this section, apart from the regular knowledge that the what we for the section, etc. I think most interesting case is that like for ourselves, like when I do investments, I think every day we have new things comes up. Same thing for the tax world, and also this wealth succession world, because I think of the jurisdiction because of change in political situation and also the social structures. I think that's why a lot of these new things comes out. But however, the concept is still important. Like, for example, like the essence of the trust is to protect legal things or legitimate practices, not for wrongdoings. So this is very important. Okay, so let's take a break first. Okay.
Yeah, because the good thing is, without the legal rights to the assets, because you need to make distributions, right, in the future. So I need to own the asset in order to do it. So legally, I have to own the asset. Otherwise, I cannot discharge my duties. That's why, if let's say you put give the asset to me as a trustee, you have to transfer the asset to me. Yes, that's a legal right. So legally, you can transfer the assets. I mean, but because usually legal right comes with the beneficial enjoyment, right? The trust means I only have the legal title to it, but I cannot enjoy it. Yes, but at the time of transfer, I would have the document showing that you're transferring me as trustee, so that let's say you transfer a house to me. I cannot have a house party and invite you because I don't have the right to buy the house. Yeah. So if I do it, you can sue me. Does that make sense? Did I answer the question? Well, first, you have to trust the trustee, right? So I think you also need to know whether the trustee has the right to do it, and then what is the right language. Yes, legally. However, if you're one that trusts the last one, then that's the trustee. Why are you doing it? I'll die. Right? So you need to know how to choose the next trustee. Right? Oh, that's okay. See, because when it's bankrupt, legally, the trust will ask for you the trustee automatically. So you can choose, but the money, the creditors of trustee cannot touch the money because it's separated. So you can either, in the trustee's name, if trustee A is bankrupt, I pick trustee 2, or I delegate the choice of trustee to these two friends who will help you to pay, or let the court decide. They help you to fund. But it will not be hanging there without anyone. Yeah. It's convenient. But joint account is so okay, let's say you and I join an account. I die, I pass it you, but you're a human being too. So you have to find another person to join. But what if the other person is a US person? Then the whole account needs to be taxed in the US. So sometimes you just don't have enough people to do it. What if the other person is, oh, I'm so nice, I like to give my money away. So you join an account, no, I don't want to join an account with this person. He or she will spend all my money. Yeah, so, yeah. It's, when you go through the criteria, you start to realize, yeah, there are necessary candidates. They are. They are not willing to do it. It's a lots of responsibility. So usually husband and wife. But getting other people, offshore holding company, yes. Not a must, but it's the trustee. It's up to the trustee. And most trustees will want it because they want to make sure it's clear. Because as I said, let's say for I'm the trustee, I use ABC. All three of you want to do the same thing. You have 3 trusts. I get confused. Is this kind of yours with no money, right? So no, because trustee usually you pick
a tax-free jurisdiction. Yeah, but that's not. Yeah, BVI, Cayman, Bermuda, Jersey, Guernsey, Guam, they're like about 30 places like this. We use BVI because it's most common, it's cheaper. Also, there are some other tax benefits. Remember, I was saying if I buy US shares, I die, I'll pay estate tax. A trust buy US shares, like a company buy no problem. German shares do. So a company also help function as what I call estate tax blocker. If the settle die with the company, there's no estate tax. The trustee has no obligation to make money for you, but the trustee needs to demonstrate that they try their very best to do the right thing for you. Okay, so putting money in safe deposit, term deposit, it's not the right thing to do because the interest cannot be inflation. That means you think you're making money, but you're actually losing money. Yes, yes. Because there are many other decisions. Remember I was saying that case where the person went missing, and then the trustee decided, okay, this thing is not death, but the husband, the wife and children lose money. Yeah, the investment person cannot make that decision. Yeah, because the investment decision, to be honest, is much easier to find in investment professionals. But a trust professional, much more difficult to find. So that's why this structure, no problem. If you delegate to investment professional, you have many choices. But that person will not want to take trust responsibility. Because it's a lot of legal and tax issue and not too many people have. Like for example, let's say the Lucinda Trust is the two friends. They are in the US. They are being sued. The trust professional, no trust professional. Oh, time of distribution, big money to you. Hey, I'm in the middle of a lawsuit. Now I lose. The money will go to the winner. But if I'm a smart person, I will look at the case and say, hey, it's actually pay the lawyer, try to get a lawyer to help you fight you. So a good trust professional can do a much better job by resolving this. Because we're handling risk. Could be, nothing happened. Everything is good. You feel that your trust is based on risk. Don't think that. It's like you buy medical insurance. You don't want to use it, right? You want to make sure it's like a waste of money. That means you're healthy. It's a bit like this. Yeah. That's why I in the beginning of the class I say this is not wealth creation. We're protecting your interests. Nothing happened. That means we're protected. Welcome. I hope you find this interesting.
I have two questions.
Yeah, sure.
The first one is about the will, because you have mentioned that the new will automatically cancel the old will.
In most common law jurisdictions.
So I'm wondering why there isn't a policy stating that when a new will is created, the beneficiaries of the old will must be informed. Why there is a policy stating that?
Well, think about it. If you really want your beneficiaries to know more, maybe you start giving them money, right? Usually you wouldn't want to do it because what if they go against me? Right? What if not your children, but their spouses start to say, oh, this old man, he should die, so we can get your money. Yeah, so that's why I don't think I've seen a jurisdiction where a will is registered because of this. It just creates a lot more tension. What if you change your mind? You told me you're going to give money to me, and then so you say, hey, you're not going to give money to me? Sorry, I'm not going to be a friend of you. Like, it creates more problems. Yeah.
So it can be served as a kind of protection for the person who created it.
Because the present creator will have the flexibility, have the choice to keep changing his or her mind, right? Because I'm still alive. If you two don't treat me well, why do we all want to give money to you, right? But I don't want to tell you. Right? Because they could be, maybe I still like you, but hey, you two actually have more money than I do. They don't have money, maybe I want to look up the deck instead. It's my money. I should have no stress when I change my mind. But if I tell you in advance, that is stress. Does that make sense?
Yeah, I really make sense.
Yeah.
I have another quick question. So after the settler has passed away, the trustee fee will the trustee fee be subtracted from the
Yes. The trust documents will already have a clause in it doing that. Otherwise, no one would want to take that service. Like, who's going to pay my fee?
So how can a trustee how can a trust business can be terminated or it will last forever?
Up to the 1% of the trust. You can say, okay, when my eldest son reaches 35, I give the money to everyone.
Okay.
Or the beneficiaries altogether say, we don't want to trust. That's expensive. That's okay. Yeah.
Thank you.
You're welcome.
好多，玛丽医院真的很厉害。对对对，我是当时去玛丽，大半夜的去玛丽。对，我觉得那中药没有用。对，他给我开了一个止咳水，然后还有几样，但我觉得止咳水是最有用的。我觉得也没有说彻底，可能偶尔也还要咳几声。对，我也觉得，但是效果真的很好。
So, do you diversify happens one of those companies which are system liable? Because you've done the best. You have to demonstrate that you've done your best. You're careful in making that investment decision. It's not to make money. It's not making money to be a wrong decision. It will be too risky. You have to follow the best investment strategies. So the settler will discuss with trustee what they want to do. Like for example, they may say, I want US dollars. I only want to take the top. For example. So if the whole US market drops, you cannot blame the trustee. The settler is the one who make that exception. The one who sets up the trust. So you can reason.
What's also like one question is actually related to that. I remember you talked about like your sister.
Yeah.
One of them didn't work really well with the person. It's also interesting parts, but we need to like encourage them to make decisions.
The trustee is supposed to diversify. Something pressure. Both decisions were bad decisions. 100% real estate, 100% stock market. It should be balanced.
But that's for the trustee to bring up to the settler, like to
No,
advise.
the settler gave the decision to the trustee. The trustee committed.
So what is the right action if something like that happens?
Well, if the sister went to the trustee says, okay, I understand you want to have it, but you only got this money. If everything goes first, there's no income because you're living, right? So why don't you first buy your house, want to rent, and then don't pay everything because your mortgage, so we have some money in the financial market. That would be a better, much better conversation. No one can predict which market will go up or down, but at least I went with the scenario and you think that's good. So the trustee should be proactive, suggesting this and not, you want this? Sure, easy, let's do it. That's a lot. Just like putting everything in investment. Hey, you're renting, you have money. Maybe you should buy it. See, so I am not saying what the need for the younger sister is right. But just that the younger sister got 20 times. That's why she's a happy. But in my view, trustee cannot do it. Yes, the trustee should be able to do it. Or the trustee these days, the new law, investment specialist. Most of yes, the trustee don't want to be seen. Another trustee is professionally trained as an investment manager. But if the trustee is not trained to do so, and you do it, and you lost money, and the beneficiaries sue you, losing money is not the problem. The money, the problem is, why do you think it's investment decision? What's the strategy? That's wrong. You're supposed to have a financial duty. You're supposed to be smart and average investor. So that's why I sense that the higher investing inflation will help. That is being seen as the right thing to do. Does that make sense? Yeah. That's why I believe yes, don't confuse wrong decision and losing money. Okay? Losing money is not a wrong decision. Because if the whole market drops, losing money makes sense because you follow the market, right? But if you always use the benchmark, if the market is up 15%, you are up 5, the market is 5 and lose 10, that is a problem. Does it make sense? You're always worse than the average, and you claim yourself as a professional. And not just one time, long tolerance. You need more legal and tax. Yeah.
So it's not a question of like seniority or like experience, but more like
The training is different. One is making money, one is protecting. Some people can do both, but it's a wait. I mean, we've been in this business more than 30 years. We still learn. I just told you the UK tax just changed a few days ago. So in the past few nights, I'm studying everything all over again. So no matter how many years of experience I have, it's irrelevant. It's always changing.
so that's I guess the main difference between higher. I don't know what else.
Well, we call wealth planning. Yeah.
So it's wealth management.
Yeah, one is to make money, one is to protect your assets. That's why I made that opening remarks. It's a two different hands. No. It's a two different hands. One is to make money, one is to make sure that the money is not lost because of tax, credit risk, wars, and all these things. So that's why it's
What would you say is that the difference between like how you manage your finance? I guess it's like
you need both. You need both. Yeah, you need both. You need both. Okay, of course, some people, okay, I don't mind having three jobs. Then that's okay. One person can cover everything. But most people in our industry is what we call a generalist of all fields, and specialists in one field. So you know the basic of everything, you're able to recognize it. Let's say, oh, your daughter's getting married? No, you're very excited. Let me wealth planning strategy. Maybe something needs to be done. Don't get to a prenup. I mean, some people don't like prenup. That's not cool. Let's do something else. Yeah, so maybe in the trust, you simply say, hey, my daughter is in money, exclude the law, the standing law. So if he's in a divorce, you cannot touch the trust asset. And the thing is, your future son-in-law doesn't have to sign. It can be done behind the scenes. But you sign a prenup, I've gone to 3 weddings in my life that got canceled on the day of the wedding. Because some wonderful lawyer decided, hey, you guys better sign a prenup before exchanging vows.
Do Hong Kong have prenup?
No.
What a
Hong Kong
shame.
prenup is only a reference. It helps, but it's not legally binding. but it gives the court a guideline how to split asset if something happens. Because you sign prenup, that's mean you guys are in good terms. Yeah, a trust is more effective.
So I remember USA has prenup, right?
Yes.
But Hong Kong has
Yeah.
no.
Yeah. Hong Kong is very late in developing court cases on family law, but it has been very profitable business. Most of my legal friends are now all doing divorces. In the past, they're all trust lawyers. Now they're all divorce lawyers.
So we can use trust to do something like prenup in Hong
Yes.
Kong. Wow, that's powerful.
That's legal, but it has to be the right circumstances. So it's like, okay, I think I'm going to get a divorce tomorrow. Let's do a trust today. No, you cannot. That will not happen. You cannot do a trust for the sake of excluding the spouse. You have to do it way before her. So the best is that parents do it for the children, especially when they're young. Your future in-law has not been born. That means you're not biased against anyone. That is very sick. Actually, I don't know whether you read some entertainment news. There's some famous actress got married to wealthy families, and the report saying, "Hey, congratulations! So you're wealthy, married to a wealthy family. So when you get divorced, you're gonna get lots of money." It's kind of strange greetings on the day of marriage, right? Yeah. And then the lady said, "Actually, no. He should be the lucky guy, you know? He's a trust baby. All the money actually is in the family trust. I get nothing. But you know what? I have a lot of personal assets. So we got divorced. He's the lucky man." So that law, that is, it's good because that trust was set up a long time ago, way before she was born. So it's nothing against her. It's just how the family protection is being set. And also, if you read the news, sometimes you see why these individuals get run bankrupt. But he or she having a good life.
As far as I know,
Because the trustee looks after the beneficiaries, even when she's not bankrupt.
as far as I know, family office is a relative new term.
It is very new terms because now it's in the legislation. But the family office, as I said, is a very simple concept, meaning the family asset is big enough to look after it in a professional way. Meaning that, if the family member have no investment specialist, hire someone. If the family, because you have to worry about tax only if you have money. If you have no money, you don't have to worry about tax, right?
Sure.
Then yeah, let's have some tax specialists going through the issues and see whether there's any tax exposure. So that's why the family office concept, even though it's a new concept, but the activities are always there.
But why is it more prominent now? What is the change
because
that led to that?
Because this is a more tricky question. Because in Hong Kong and in Singapore, if you buy a stock and you sell, you make money. That's not taxable because that's capital gain. However, you buy stocks, trade very actively. The government tax authority will say, "Hey, you're actually making a living by trading stocks. That's called profit, which is taxable." So you say, "I don't understand the difference." Nobody does. So, but this gray area has always existed in all the common law jurisdictions like Hong Kong, Singapore, the UK, Canada, and so on. So Hong Kong and Singapore say, "Okay, I want to attract more wealthy individuals to come here. Let's make it more clear. You no need to be blurred. No tax. Whether you trade actively or you hold it by yourself." But they don't want to offer this to everyone. They only want to offer it to the wealthy individuals. So that's why both Hong Kong and Singapore now have this family office regime. If your asset size reaches a certain amount, you can get this tax status they don't care about whether you make profit or capital gain or tax free. That's why this term is now popular.
Oh, so it's based on the legislation.
Yes. But the activities within a family office, including what I said, the tax, personal security,
Yeah.
when you travel, how do you make sure that your family member don't get kidnapped? Your travel insurance, your health insurance, your schooling. Sometimes the office manage your credit card spending because sometimes they are very big. So they organize it like a company saying that, okay, each one of you can spend $1 million a year, but each meal cannot cost more than 10,000. None of your church can cost more than 20. That sort of thing. You have to follow. When you submit your claims, I'll cross-check.
So can I?
Yeah. No, family office can do that too. Yeah.
Can I understand family office as there's still private banking, most of it, but it's just different terms to
Yeah, but private banking can only do certain things because the family office activities
yeah
are quite
more
wide.
comprehensive.
It could be education, but the bank cannot offer too much. They just some sharing, right? Maybe some training, but cannot do everything for the family. So the family office itself has to find the right service provider to make it complete. And each family is different. And then when they move to different stages, their needs are different. Like for example, we manage some of the family office where the family now only have block of buildings. So the family office only have to collect rent and then keep everybody money. So the family office actually has a lot of plumbers, electrician to solve out the problems of the tenants. So the bank cannot provide that, right?
Yeah. Makes sense.
It depends on the particular. It's like a private kitchen.
Yes, yes. It's like a 管家.
Yeah, but Bunga doesn't own the asset. So in a right family office, you use a trust, you own the assets. So your level
Your
is
level.
a little bit
Yeah.
higher. Usually trustees. Yeah, because without a trustee, once the principal passed away, okay, I'm restricting each of you spend $1 million a year. I passed away. Oh, now I get each one get 100 million. No need for restriction, right? So if I want to continue to control spending, I need to put my money in the trust. So that after I passed away, the trustee takes over. Does that make sense?
Makes sense.
Do you need like in order to open a family office? Can you say that you need private bank for individuals, or can you directly
Yeah, well, I think in the private banking world, because we deal with so many wealthy families, so naturally I have
The
lots
skill
of
set.
best practices I can share. Because sometimes you say, hey, I don't know how to do it. No worries. Let me share with you what other people have done. Like a buffet. Why don't you pick and choose something that you think that fit you, and then we'll amend it on the way. Yeah, because it's very hard to do from zero all the way to a full family office. So let's say I just talked to a family. I said, like, they have 5 sisters in the family, and each one is like 70 years old. So the family chart is like this. I said, okay, let's just do one small thing for this family and see whether you like it, and then we'll expand. Yeah, because otherwise, there are too many parts, just cannot. Yeah, it's a big topic, to be honest. So this is more like a structure.
Would you say that like everybody has a different like investment or like the way that you manage like trust? Is it about like are you I don't know how to ask the question, but is there different needs in your family?
Yeah. Like, as simple as clients, we are French clients. So naturally, clients who are very, the European part and Asian part we can handle. But we don't have a presence in the US. So if there's a branch family in the US, I will need to get a US bank to help. Like for me, I get Bank of New York Mellon to help. So as a family office person, even though I work for a bank, it's impossible for my bank to entertain all the requests. I have to find other people. It's like not helpful on investments. So that's why if you are in the private banking industry long enough, you know enough people. So it's easy to get a team of people to help. It's never a one-person job, that's for sure.
Oh, you should come to see. Do that. Goodbye. So you guys find this enjoyable.
Thank you.
Bye. Bye. Okay. Okay, so let's come back to our lecture. So our second part of the lecture, we'll spend some time on talk about alternate investments. So next week we will have another guest speaker who used to be my colleague as well from the bank, and then he's the head of the alternate investment on the bank right now. So he will give some light example and then how banks deal with this alternate investment. But before that, I think this is I gave you the introduction first so that next week you will know what he's talking about, so we have a better understanding. So, what is alternate investment? So what are alternate investments? So alternative investment is a type of investment that falling outside the long-only category in the traditional asset classes of cash, bonds, and stocks. So you have studied investment instruments, cash, stock, and bonds. So anything that beyond this long-only thing, we call it alternative investment. That's why the alternative investment can be a very large space and may involve in non-traditional vehicles and may involve something that set up specially for this investment, and then also may involve in non-traditional strategies. That means what we call traditional strategies is that when you invest something, you put your cash into that thing. Hopefully, you will get back the cash and the return later date. So that will be the non-traditional. And also, they have different liquidity profile. So not like your traditional asset class, like first is that the traditional asset class is mainly cash, bond, and equity. These are the most traditional asset class, and then most widely available if you go to the bank. I think a retail bank to buy funds on that. And then usually these traditional asset class in general have daily liquidity. You can sell and buy anytime when there's financial markets open. You can sell and buy on Sunday, except Bitcoin. Bitcoin is not a traditional asset class anyway. So these can including hedge funds, private equities, private credit, commodities, real estate, art, and collectibles. And also, right now, I should even including the crypto assets, because right now crypto assets become more and more widely acceptable by the investment communities as one of the alternative investment thing. So what are the common characteristics of these alternative investment? First, they may have limited liquidity. This limited liquidity means that you may not be able to buy when you want, whenever you want, or you cannot, when you invested into it, you may not able to sell when you want to sell. So that's why they have limited liquidity in subscription, in buying as well as in redemption. So that's why they may have limited liquidity. And then usually they have specialized managers, investment managers with active management strategies. So these are usually active managers. And then their strategies sometimes may be different from traditional investment strategies, but sometimes may be similar. So that's why they may have specialized investment managers. And then also they are less regulated, as well as less transparent. So that's why in Hong Kong, not everybody can buy alternative investments from the bank. So first, the bank must be classified this client as a professional investor that I will talk about later. What is the qualification as a professional investor? And also, for these alternative investments, they will code it as a compact products, and they require special knowledge before you can invest into these products. And there will be usually the historical return and risk data are not widely available to public. So for example, you want to buy a hedge fund, and then you see a name of a hedge fund like, for example, like Ray Dalio's Bridgewater hedge funds, and then you want to know about it, you want to invest into them, and then you ask Bridgewater, I want to know the data, sorry, they will not give you. And then not like if you buy mutual funds, not only fund you can easily available to get information from corporate. So these hedge funds are usually pretty opaque and then pretty difficult to be transparent. And usually they have a specific legalized structures. So what does it mean by legalized structure? Usually they have either they have a GP-LP structure, I will explain later, or they have a setup being as a trust or a special investment vehicle, a company. For example, like remember we talked about your last week on structured product like these CDOs. Actually, CDO is a kind of alternative investment, but just these people packaging as a product. And then their fee structure are different. So unlike the normal traditional funds, they charge you a management fee and then a subscription fee. But for fee structure in these alternative investments, usually they have a higher management fee and also have an incentive performance fee. That means when the performance up to a certain level, the fund manager will charge you the performance fee, or we call it the carry, C-A-R-I-D-E. So we say, for example, like a very traditional type of fee structure is 220. That means they will charge 2% management fee and 20% carry. That means when you make 10%, 2% will goes to the fund managers, and 8% you will keep by yourself. And then some of the asset classes that they will try to perform a lower correlation and with on the traditional investment asset class. That means that the people why we want to invest in alternative investment, that from a portfolio perspective, we want these assets to be moving differently with the traditional asset class so that I can diversify the risk. We'll explain a bit later how does it do that. And then we will emphasize more on the absolute return for the alternative investment and aim for high return arising from market inefficiencies. So that's why at the same time we want to use the special strategies, because we think that these special strategies can give me an exceptional return, and that they find some market inefficiency so that I can make this return through a special trading techniques. So we call it seeking alpha. So on that means you get the exceptional return over the market, and usually they will incorporate some leverage on that. And these are mainly offering to professional investors, as I mentioned before. Not retail investor can buy. If you go to a bank and you want to buy equity, sorry, they won't sell you. Or you go to a bank, retail bank to buy a hedge fund, they won't sell you. They're not offering this to you. So these are mainly offering to the high net worth individuals or the professional institutional investors. But however, right now, because more and more these private banks would like to offer this alternative investment to the private individuals. That's why we have to study it and then know what it is. So common alternative. So let's go through one by one the main product of alternative investment. First one, pretty straightforward, is the hedge funds. So you heard that the biggest universe of alternative is hedge fund and private equity. These are two most common tools that people will use. So hedge fund is a private investment vehicle that manages a portfolio of securities and or derivative position, adopting an absolute return strategies independent of market returns. So what does it mean that the hedge fund, the traditional definition of hedge fund is that disregard what happened in the market, they still like to generate return for you. That means they will try to extract some special return that the market abnormal to the market. So usually they will both long and short positions. Long, that means you buy something. Short, that means you sell something. Okay, very good. Long only investment is that you buy something so that the price goes up and you make money. This is the long way. Long, or we call it the bullish view. For short, something that when you sell something, so you think the price will go down, so can you buy back later to make money. So for example, you sell something at $10 and buy back $8, you make $2. But normally you cannot do the short one in the traditional method. You cannot say like to the bank, okay, I don't like the Alibaba stock, I want to sell. You talk to the bank, I want to sell it and then buy it later. Sorry, you cannot do that under general circumstances. And then structure, usually they are open-end structure as a limited company, and then they will have a GP-LP structure. What does it do? Anybody know what's GP stand for and LP stand for? Okay, GP stand for general partner. What's LP stand for? Okay, limited partner. So what does it mean?
One have to use his property, his money to pay the company that is bankrupt.
No. Okay, basically the GP and LP is yes, okay.
The GP, I think, is general partner, so it's the fund management assets. And LP, general partner is the investors who let the GP invest. Sometimes GP, they will put their money into the fund as well as kind of a GP.
Yes, right. So actually, is one of the classmates mentioned that GP basically is the manager, and then there's the general partner, and the LP is the one that investing into the pool of money to become the limited partner. So however, the ownership is belong to the LP. So that's why in case that some usually they enter into the terms of the fund, the GPLP structure, if some of the things change and the GP want to change some of the terms of structure, they need all the LP's approval. Because the LP is the real owner of the financial beneficiary of the financial asset. But the financial beneficiary of these structure, they do not have the right to make investment decision. So that's why it's the GPLP structure. So very common on the private equity structure, and also some of the hedge fund structures. And then there's for these hedge funds, they usually have a specific subscription and redemption terms. What does it mean is that, say for example, some of the funds usually have a monthly redemption, monthly subscription. That means you can only subscribe on every month end, use the NAV to subscribe. And then, so say for example, now is in the middle of the month, I want to buy this hedge fund. Sorry, you have to wait until the end of the month. I won't take your money until the end of the month. So that's why they will have a window that every month you can allow to subscribe. How about redemption? So usually redemption is that the best or the most friendly redemption is that maybe monthly. So you allow a monthly redemption, and then you need to give a bit of notice for the fund manager that you want to redeem. For example, like today is March. I want to exit my hedge fund in end of March. So today is 20 something of March. Can I do so? Sorry, no. Usually they need you maybe 15 days notice. So that's why if you want to redeem your fund in end of March, you have to notify the hedge fund manager 15 days before the end of the month. So that's why if I want to redeem my fund, the earliest day I can do is April. That means I can tell them I want to redeem my fund at the end of April. So then now I put into the subscription redemption notice. That means the hedge fund will be based on the end of April's valuation and give back the money to you based on the end of April valuation. This is we call the redemption terms. So most friendly redemption is quite common, is monthly. But however, usually I think that nowadays most the hedge fund they will put down quarterly redemption terms. That means they will only allow you to redeem on a quarterly basis. It's quite common. And Sometimes we will also have the fund of hedge funds. That means you have a pool. Instead of buying a single hedge fund, you buy a pool of hedge funds together. So usually the fee structure is like that: the management fee plus the performance fee with a high watermark. So I will explain it later. So strategies including the equity long short, risk arbitrage, distressed securities, convertible arbitrage, fixed income arbitrage, managed future, and global macro. All these names, they will involve some kinds of different kind of trading strategies, how the way the fund manager invest their money, and also what kinds of area they will put the money. So I think that you have a course talk about hedge fund or alternative investment. So, but I will give you a bit of the different strategy. What does it mean later when we talk about the hedge funds? So let's look at that. Some people will ask why it is called hedge funds. So actually, this is the beginning of the hedge fund story. So in 1949, a person called Alfred Winslow Jones and raised $100,000 and launched his first hedge fund. He tried to minimize the risk in holding long-term equity positions by short selling other stocks. He used leverage, share risk through a limited partnership with other investors, and compensated the managing partner according to performance. So this is exactly the beginning of the hedge fund. So Mr. Jones, he's very good in doing these activities. So that's why his friends asked him to manage his money. And then because his friend doesn't mind to pay him a fee if he can perform better, because you cannot do it on your own. That's why in order to tease Mr. Jones to help them, that's why they would like to pay him a performance fee. So that's why the hedge funds are private investment vehicle that employ pool funds together in many different strategies to earn active return or alpha to the investors. So right now there's around 10,000 hedge funds globally. So that's why there's a lot of hedge funds, and some are success and some are failure. So this is exactly how the structure looks like. So Mr. X has an expertise so investing other people's money, with getting compensated for his time and performance. He raise money with accredited investors, that means some kind of a professional investor. So he then dropped agreement by charging 2% management fee and 20% incentive fee on any profit, subject to high water mark. So 10 investors agreed to the condition and sign up for the fund by investing 10 million. So the fund for X Capital now has 100 million to under investment. So X Capital can invest in any asset class, depends on the strategy. Stock, derivative currency, fixed income, and so forth. You can use leverage. So this is a typical hedge fund structure. So think about that. How does it compare with the traditional fund structure? Traditional buy long only, particularly you buy a Hong Kong stock, China funds. So Hong Kong stock currency, you have a manager, you also charge a management fee, but you don't have performance fee. And then you cannot short, but this one you can short and long. And this can leverage. That means he can invest more than 100% of the cash in the account by lending, by borrowing money to it. How does he do that? So let me give you some example. for a long only manager, so usually you have 100% cash if you're fully invested, and then if the market goes up and down, you will be moving like that, and then usually you have a little bit of cash for long only manager. But if for a hedge fund, depends on the mandate. So for example, you can do some shorts. So for a hedge fund, so when he buy $100, he can short another $50. So that means net he's long 50. He can something like that. So usually this line will be quite in this. It's the difference between this minus this, the net line. So usually whenever we ask the people's positions, especially for example, if we buy $100, he short 50, his net is 50. If he long 120, he short 60, that means his net long is 60. So usually this is the long short manager's pattern. So for the long and the short, and then think about that. For the risk, if you remember the early case, you have only long. If the market goes up, that means it will goes up together. If it goes down, it will go down together. But for example, if this is you have long and short, actually, okay, like this in the first place, if the fund manager long $100, that means he has $100, he buy $100 of stocks, but at the same time he short $50. So his net position is 50 because he long 100 and then short 50. So what is his gross position?
Long 50.
Net is long 50, gross. Yes, 150, right. So that means by doing that, his long 100, short 50, his net is 50. But actually his gross is 150. That means he can trade $150 of stocks. It's all together. Why we want to know these elements in the hedge fund? Because the more position he takes, the more risk is taken, despite the direction. Say for example, okay, if say for example like take Hong Kong stock for example, if he long $100 in 10 cents, and then he short $50 in Alibaba, say for example. So Tencent and Alibaba move usually in the same direction, then his risk is less. But say for example, if long $100 in Tencent and short $50 in China Mobile, so it may happen that Tencent goes down and China Mobile goes up. So he's taking double risk. So assume he's right. If it's the same sector, the risk is less. But if it's different sector, the risk may be enlarged. That's why when we analyze a hedge fund, we have to know his strategy and know his long and the short. But usually, say for example, according to the traditional way of hedge fund, the original way of hedge fund is that they will use the pairing of stocks, like a long. For example, the most basic way of doing long short hedge fund is that I long a stock in the same long and short with the same sector. That will be the less risk. Say for example, I have two banks, HSBC and Hang Seng Bank. I know that HSBC always perform better than Hang Seng Bank, so I can long HSBC and short Hang Seng Bank. If both goes down, if the short goes down more, I make money. If both goes up more, I still make money. So that's why disregard the market movement, I still make money. But however, some will be cross-sector long short. If I long bank and short tech stock, if they just go on the reverse direction, I will double hit or double win, depends on your strategy. And then another way of doing that is that people will use the index as the market has. Say for example, I think the market is bad, so I short the index. But I think stock, like for example, earnings of Ping An Insurance is very good. I want to long in Ping An, I want to long some bank stock. I buy banks and then Ping An Insurance and then sort the index, so that the index come down more but my stock come down less, I still make money. So say for example, if the long the thing that is down by 10%, the short, if the long position I down 5% and the short position I down 10%, I still better. Then I still make money. That's why sometimes when you invest, in a hedge fund, you will never know his performance until he gives you the investment report. Not necessarily when you see the market, you will know whether you're making money or not. But when you're buying a long only fund, say for example, I buy a Hong Kong stock market fund, when next morning when you come up, wake up and see Hang Seng Index drop 500 points, probably your fund valuation will drop because this is long only. So this is something that's why when we go into the hedge fund, we have to know this exact strategy and detail. This is just one example, but this is the most common way of people look at their gross and net exposure. How is this being calculated? So that's why sometimes when a person say that if I'm long 100, I short 100, and then my net is almost 0. But my gross will be 200. So in this case, actually, this fund manager is taking higher risk than the one I mentioned, because his gross position is 200 now compared to 100, 150. But however, he takes almost no beta risk. That means less market beta risk. That means disregard what might happen. If the general market doesn't move, he probably may not have such a big swing. But really depends on the stock takes. So that's why usually hedge fund managers are good in stock taking. They will try to find the outperform one and then to short the underperformer. But we still have to analyze how big is the leverage, because in this case he is leveraged 2 times because he's $100, but he take $200 position on this case. So usually when you leverage more, supposedly you're taking a higher risk. But this is in general, but of course you have to go into detail whether they are industry-wise long short or cross-industry long short. If it is cross-industry long short, that means the risk even higher. That's why we have a lot of parameters to evaluate a specific hedge fund's exposure. But this is in general how we do that. So any question for the equity long short part? example here on this side. Okay. So say for example, I'm a US equity manager. I long Apple. I long Microsoft. I long JP Morgan. I long, like, say, Walmart. For example, this is my bullish call. I long this all stock. And then if I'm just a single manager, I'm a long only manager, I buy these 4 stocks. So you probably know that if the market goes up, I make money. If the market goes down, I lose money because these are big market index stocks. However, if I think the market is not very good, the general market is not very good, I can do another thing is that by shorting S&P futures. So, say for example, I can do the short S&P futures. Say for example, if these 4 stocks are accounting for, say, like 10% of the market cap of S&P, then I will short roughly 0. I will short the S&P futures. With the same amount. My net exposure probably will be 10% of the S&P because this is, they will represent around 10% of the index. The volatility will be contained to around 10% because this is represent 10% index, not fully hedged. So this is something that people will roughly this calculation. But however, it is not always the case. But according to historical data, this is accounting for 10% of the movement. There will be something like that. But this is fully hedged. But if, say, for example, I'm not shorting 100%, maybe I short 80%, then I'm still long, net long 20%. That means the market goes up, I feel better. But in case, if I'm shorting 100%, matching it, so that means if these stocks outperform the market, I will be better off. So, say for example, if it's down 10%, this basket may be down, say like 8%, I still make 2%. Or if the market goes up, say like 12%, and these go up by 8%, I still better off. So this is something that people will do. So usually hedge fund, when they are doing a properly hedge, they will minimize the volatility. They only extract the market alpha, we call it alpha. Or if he doesn't want to do that, instead he short like BAC, Bank America, and he short Target, and he short Meta, and he short another computer stock, for example, like he short Google. For example, if you do something like that, that means he thinks these 4 stocks outperforming these 4 stocks. So in case this just similar like that, because they are same sector, that's why the volatility will be, overall the volatility will be not as much as the previous one. However, when people do like that, usually they will do something like that. Instead of 100, they will do 200. because they know that the volatility, the intra-market volatility will be less. That's why they would like to bet high. So in this case, so that try to capture the high return. That's why they will incorporate some leverage for this kind of thing. That's why I usually have some managers, they may have at most they can do up to 2 or 3 or 4 times leverage. So they think you know to capture a bigger move. But in case they're wrong, if they for the people they long, it's not going up instead of going down, and for the people they short, it's going up instead of going down, so they double whammy. So this is how we explain the long short part.
I would like to ask, do hedge fund generally outperform a simple long fund?
No, because he cannot. Because if he's a long short, he will not outperform the simple long fund in the general market usually. Because you give up the volatility here. If especially when you're not leveraged. So because remember that like for the earlier part. In general, the S&P long term is going up, right? But when you're doing that, definitely because you're shorting S&P, that's why you capture some kind of return on the we call it the alpha. You miss the beta, you miss the market part. But why still people like to invest in Canada? Because they want something that steady,
Stable.
or less volatility and not falling to market. For example, like I can give you some examples next week that some hedge fund managers they really can say because they can adjust this long short size. If they think the market is still very bad, they can even short more if they're good on that. So that's why they can prevent the withdrawal. So think about that. Who will be willing to do this hedge fund managers? It's the one thing that they will outperform the market, right? If they think the market is bad, I still want to invest in money, I have to short. Otherwise, people will take the money away. If the market is bad, I'm still losing money. If a long-only manager, for the Hong Kong market right now, people just withdraw my money. So that's why in order to protect my AUM as an under management, I have to do something that can protect the client's money so that they will rely on me. And the thing that one of the philosophies that on investing, usually for a general public, when you see a market crash, the next rebound will be very fast. For a general normal person, you will not be able to get into the market fast enough. But the professional manager usually they stay invested. That's why they can get to the market fast enough. That's why they can capture the rebound. So that's why the hedge fund manager usually rebound will be very fast when the market returns. But not the long-only managers. And the thing that remember one of these specialties of hedge fund is that you cannot redeem the money whenever you want. You have a redemption window. So usually when will people redeem money from the investment? Is that when they see the market correction, when it's fear of future loss. So that's why they redeem and they go to bank, I want to liquidate the fund. So but because you cannot liquidate, that's why you keep invested so you can have the rebound. But usually, for example, when you see the Hang Seng Index like that, and then you want to go to the bank, I want to sell my Hong Kong China fund, I want to buy back when this rebound, but when it rebound, it's too late. Already rebound, then you go to the bank, then you just rebound. So this is why when we talk to the clients, that not necessarily always true, but it will help you to make wrong psychological decisions. Sometimes that's why we like to be private equity, because private equity is that you have to stay invested for very long term, and therefore you cannot get out when you're psychologically wrong. Usually people when you're under fear or during panic time, you will only sell in the fund. So this is we have done a lot of this study before, and I remember that when I joined JP Morgan, that was in 2009. This is quite after the financial crisis. When I look at the client portfolio, a lot of them had to unwind, unload the position in 2009. the market starts to rebound, they want to wait because they don't know whether this is bottom or not. So in the end of the day, when they confirm the market bottom, already gone up by another 10-20%, that means it's just like you will not sell when the market starts to go down. So basically, we have done a lot of these studies, and by practical example, the people, the psychological, which we will teach about the psychological cycle, then usually they will be in a bit of delay of the physical cycle. So that's why stay invested is one of the tools that we always talk to our clients, to people. So if you're, then we move on. So why do we want to choose a hedge fund? So that's why these are the hedge fund universe or hedge fund credentials we would like to look at the hedge fund managers. So remember that for the hedge fund, we want, so the characteristic of hedge fund is that they charge a higher fee, and then they have a less transparent. Also, they will take part of my performance as a carry. That's why he earns a lot. So in order for them to earn a lot, they must have some credentials so that I would like to willing to pay money. So these are the credentials. So what we are seeking alternative managers, these are the structural advantages we would like to have. So they must have a sustainable competitive edge. So usually these are the credentials that you may not be able to access in the traditional long-only manager. Like, so investment in harder to reach segment of the market, for example, like non-performing loans, Class A share, equity securitizations, or high capacity, they have complicated structure or non-standard transactions, which I don't know how to do it, or the traditional bank do not know how to do it, and then or they are niche market, investing market with limited visibility on price, and then depth of the market and participants like OTC instruments, like trading options, etc. And then also these people have execution expertise involved in restructuring and special situation requiring work of public costs and bankruptcy costs. And then they have some data and infrastructure like significant requirement of data infrastructure and legal model. So I remember that when we see a hedge fund during the financial crisis, during the COVID period. So these hedge fund managers, in order to track the trend of these the trading trend or international shipping trends, they pay for some data on satellite on the moving container ship around the world. So they will know how many container ships in which ocean is moving in which direction, so that they can calculate what kind of trading volume on that, so that they can ahead of knowing that the economic business activity of that country, of that region. So that's why they have. So not everybody can do that, and they have this data analysis, because if you know the business cycle is that the earlier part of the business cycle is that if you have the raw material containers shipping from one place to another place, let me say for example from Australia to China, you know that China has industrial production, because otherwise you don't need raw material, right? So that means they will expect this industrial production is good. Or they see a lot of China ship going from US, from China to Southeast Asia or to Japan, so they know that export is good. And then during the COVID, they see a lot of these empty containers being stayed in the port. That means there is no activity. So that's why they can based on these statistics, they can predict or calculate or forecast the trading volume. And also the most important is the future container charges. So that if you have a lot of empty containers, then the charges will be coming down. So that they can short the shipping companies or on the reverse. So that's why these are the extra data or infrastructure data that you can know about. Or they collect the electricity usage. So that's why remember that nowadays a lot of people will focus on the electricity usage in China in order to predict industrial production. Because if you want to sell something, some goods to produce, you need electricity for the factory to work. If the electricity bill is low, that means you have less activity, then it's less income. So these are something that the fund managers or the hedge fund firms, they use a lot of different kinds of scenarios to predict prices, and then they may have some insider advantage. Say some for example, like they go visiting. I remember that we talked to hedge fund manager. They said that how they do the game, you know, the video game, mobile game. They in US they hire a lot of students, university students, and pay them to play the games, and then to write the report for the fund manager, so that they know what the new games are more welcome, and then so that they can predict their sales in future. So these are they have all kinds of expertise. But if you are on the traditional fund managers, because the fees received is less, so they cannot hire so much people to do these statistics. So that's why hedge fund managers, they may have that expertise that will be irreplaceable by the traditional managers. So that's why when we go into working with a hedge fund, we want to know how do you make money, how do you come up with the investment idea, and how do you do risk control. These are the things we want to know. And then also when we go into the manager selection part, we will go through that, how we check the potential of these managers. So to following are the examples and strategies with structural advantage. For example, like we have different strategies, like we have structured credit and leverage loan. We have quant-oriented strategy. We have distressed debt, special situation, and activism. So these are, what are they? So for structured credit and leverage loan, managers able to participate across risk, tranche, and loan origination, because different legal structure will dictate the receivership or the priority of the credit. So that's why people are already lectured that. So that's why they will know, inaccessible to most investors, require complex and expensive system, able to participate in setting loan terms. That's why when they structure a loan debt protecting the credit. And quant managers can have access to almost any data. The one I talk about, deep proprietary analytics, they have their own analytical way so that they can generate some trends of the market, of the capital market. And the stress test involved in bankruptcy, asset disposition, and corporate restructuring. So people are specialized on this stress test when they see bankruptcy. For example, for these kind of managers, what they want to like is that they will open every day they look at the news to see which company is under Chapter 11. When they see something under Chapter 11, they start looking into any structuring possibility. So you know that in US, when this is Chapter 11, doesn't mean you're bankrupt. That means you become a company protector, that you can undergo a structuring process, restructure the debt and etc. So that's the people comes in. So think about that, when you have a debt issue in 100, now because of the credit deteriorate, the debt become 50%, down 50%. So people, if they undergoing a restructuring and they think that go into the balance sheet of the company, they think that the company after restructuring, the debt from $50 can be replaced by another debt with $60. Then they may go into it because they will make 20% already. So that's why people will calculate a lot of these financial analysis of individual company in order to find opportunities. So that's why this is expertise. And activism. Activism is very common in the US financial market, because US and European financial market, because you look at the shareholder structure of these large listed companies, most of them do not have a single large shareholder. So none of them have more than 50%. Like having 10, 15% is very high, or even single digit percentage. For example, one of the very famous activism managers that like Third Point, you can think about it. Like Third Point is a very large US special situation manager. He invested in Sony some years ago. He thinks Sony has underperformed, but he thinks Sony is a very good company, has a lot of good assets. They have entertainment, they have games, they have TV, they have etc. But the management just don't know how to manage so many businesses. That's why they get into Sony, and then when they buy enough shares, so that become a significant shareholder, so they can go into the board, and then influencing the other board of directors, so that they can make change. And another also another type of activist managers that they when they acquire certain shares, they write a paper so that I am a 5% shareholder of P&G. I think the management of P&G is blah 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 very bad. And I recommend them to do that. So they issue this white paper for the company, so that everybody look at the white paper and then give pressure for the management to change. Because when these ethics research manager write something which is logical and feasible, the other institutions will buy in, so they will vote to force the board of directors to change. If the board of directors doesn't want to change, they can vote to fire the board of directors. So that's why this is we call it the activism on this. That's why they will do something to improve the shareholder return to that. Because if they don't do that, the board of director or the manager will just sit and then do nothing. It doesn't mind to them because they still have a high paid CEO. For example, like Boeing, I think you read the news that like Boeing, the CEO and chairman is fired by the end of the year because Boeing has so many bad news come up with the recent accidents. And then I think this is the shareholder give a lot of pressure for the board of directors, and the board of directors has to do something to fire the CEOs. So these are the activism.
How are there a lot of activism or so little, so few?
Do you mean activism?
Yeah, this strategy.
There's a lot in US, but not recent, not in the region. Because in Hong Kong or in Asia, a lot of the major shareholders is the family, or because they own 50% or 51%, disregard who say I don't want to do that, because they have the say, they have the majority stake. But in US, most of the companies are owned by the institutional client. That's why like BlackRock, like the ETF owners, they can vote against, like whenever they say something, the board of directors have to listen, because they can vote against the board. So these are and that's why they require a sizable investment and then very experienced driving the change, so that it takes a long time. Usually it takes quite a long time in order to change. Yeah. So maybe I finish this slide and we finish the class today. So for hedge funds are not homogeneous and the strategies vary significantly. So these are the these two ways look at the higher correlation to traditional market, and some are more directionally impacting the fund movement. So for example, like for this side, the upper part is the more higher correlation to the traditional market. For example, like managed futures, because they trade the movement of the future. That's why they will more in line with the market. They want to trade with the trades. And then for example, the distress, when the market is bad, so more impacting the whole economic market. And then for example, like the equity market neutral, because as I mentioned, for equity market neutral, that means that your long and the short is almost equal. That's why disregard what happened in the market, there will less correlation. But for example, like and then merger arbitrage, because mainly doing the arbitrage thing, they will have a less correlation to the financial market. While for the trading funds, you can long and short. That's why also they have lower correlation. While for the higher correlation, instead of higher net fundamental, that means people buy the fundamental stock, they are good, and then long term outperform. So they mainly high net means their exposure is net is quite high, as compared to 50, they probably will be 80, 70. That means directional wise, they will more correlated with traditional market. And then and also these will be more directional. That means you buy something that's good, they will go up, and then sell something that's short, they will go down. But for the trading or the merge arbitrage, they will mainly use the price inefficiency. That's why it doesn't matter the long and short. So especially for like so So next week, we will give you more example on these different types of trading strategies with a specific example. Today we are running short of time because we have another class. So we'll finish here. So next week we will have Mr. Yang. So he will come to share with you more about how the banks